professor here at Case Western, and my colleague has asked me to take over as moderator for this section since he's one of the panelists. So I'm going to introduce this panel, which is entitled Hedge Fund Activism, Voting Gambits and Tender Offers. And the lead speaker will be Professor Ed Rock from the University of Pennsylvania Law School. And the commentators will, in addition to George Dent, who you've met already, will be include Professor Onnig Dombalagian of the Tulane University Law School. It's a distinguished panel, and I'll be back for the Q&A.
Okay. Thank you, David. Thank you, George. It's a great pleasure to be here and to be on such a distinguished panel with friends and colleagues who I have a great deal of respect for. The talk today that I'm going to give is on the role of shareholder voting, but you know, there's a sense in which all of us are trapped within our childhood views of the world. So the last panel, this came out at dinner last night in an interesting sort of way. You know, John is the product of is a child of the 60s and has this notion that, you know, if we all work together, we can, and people of good faith can sort things out and get to the age of Aquarius. I'm a child of the 70s, where, you know, I got to college after the 60s was over, and one of my vivid recollections of being an undergraduate at Yale was William Sloane Coffin begging us to just occupy one building. If all we did was occupy one building, it would be great. But, you know, by the 70s, everybody was sort of cynical about the prospects of reform. And that, in fact, is a view of a kind of cynical view of the world that I carry with me to this day and carry with me to issues of corporate law. And so when I think about shareholder voting, I end up coming down in a pretty predictable way. Shareholder voting is an important part of the ideology of corporate law. But the truth of it is, of course, shareholders don't vote on very much. They vote on the election of directors. They have veto rights over some significant things, charter amendments and significant transactions. More recently, in a reformist spirit, there have been all sorts of proposals to give shareholders more things to vote on, whether it be, say, on pay or rules of the game, non-binding shareholder proposals. We keep hearing about more things shareholders should vote on. My view, consistent with being a child of the 70s, you know, don't take shareholder voting too seriously. It has a role to play, but one shouldn't count on it to do very much. That our system of counting votes is not very good, and the real shareholders don't fit the implicit theoretical model. In terms of related work, this is drawn from a couple of articles that I've written with Marcel Cahan at NYU. One is a long, very detailed work in Georgetown on how the voting system works and all the incredible things that go wrong with it, and the other is a somewhat shorter piece that we did for a Festschrift for Dan Prentice. John has done some wonderful work on shareholder voting, and much of what I know about shareholder voting I learned from John, and so his work on the mechanics is I also very much commend to you. In any discussion of shareholder voting, the opening question has to be, how are shares in U.S. corporations voted? That's how. And, you know, in any chart of that complexity, that's a chart from ISS that they were good enough to give me. In any chart of that complexity, you know all sorts of things are going to go wrong. Right? It's just a system waiting to collapse. Now, the first question on shareholder voting is, how are shares held? When they're held either directly, when you are listed as a shareholder in the books of the company, or more commonly as in a custodial relationship. When it's direct, and that's certainly no more, probably substantially less than 20% in most companies, when it's direct, you fit the model of shareholder voting implicit in the Delaware system, and it is fairly straightforward. So in direct shareholder voting, the proxy cards and the proxy statement and the annual report are sent out to the registered owners. They send in their proxies to the tabulator, who checks it against the share register and records the votes. All very simple, all very sensible. The problem, of course, is when you get to custodial ownership. And we have had custodial ownership since the 70s. That during the 60s and early 70s, there was the paper crunch in the back office crisis, which brought some brokerage houses to their knees. In response to that, we had a choice of going one of two directions. We chose to go in the direction of immobilizing share certificates and encouraging custodial ownership. It facilitates trading. There are fewer failed trades. It avoids lost shares by keeping them all in one place. It speeds the process. But the important thing to understand is that this was driven by a concern for systemic risk, for the nightmare scenario that an intermediary fails with a large volume of unsettled trades outstanding and with the ripple effects of that carrying through the system. It was not chosen for corporate governance reasons. So that this is how nominee shares are held, and this is a simplified version of it. DTC, Depository Trust Company, is a central depository in the American system. They hold the stock certificates, and the various custodians, the brokers, and the banks have accounts with DTC, and then the various customers, who in corporate law terms we think of as beneficial owners, have accounts with the custodians. Okay, so the hedge funds will have 400,000 shares in its account with Morgan Stanley, which will have an account with DTC, which will then have a DTC Morgan Stanley account, which will simply record the total number of shares held by Morgan Stanley without any indication of who holds what. Now, it's important to realize that the ownership structure in property terms is actually quite different. Article 8 of the UCC establishes the ownership structure. And under Article 8, what we think of as beneficial owners are, in fact, merely called securities entitlement holders. The intermediaries, the custodians, are securities intermediary. Now, why does that matter? The goal of the UCC is to minimize failed trades, again, for the same systemic risk reasons. What the securities entitlement holder has, who we think of as beneficial owners, the top of the chart, is not ownership rights in specific shares. So that if there's a shortfall, okay, what they have is rights is common interest held by all the entitlement holders. So if, for instance, in this picture, Morgan Stanley ends up with fewer than 530,000 shares in its DTC account, even though their customer account says they have 530,000 shares, no customer has any rights to any particular shares. Okay? So there's this mismatch between the property regime and the corporate governance regime governing custodial ownership. But let's now turn to how custodial shares are voted. It is very complex because first, when shares are held in a custodial account held in street name, first you have to figure out who the owners are. Then you have to send them out the material. Then you have to get the votes back. They have to vote the shares. You have to collect the votes, and you have to count them. And unlike voting by registered owners, here voting is neither transparent nor verifiable. So let me quickly just run through the steps. First question that the issuer has is to ask DTC, who among your members holds shares? Okay? So you first have to find that out from DTC. Once you find out who it is, on the custodial side, JP Morgan, say, and Bank of New York, Morgan Stanley, Smith Barney, then you send them search cards to find out how many copies of the proxy statement and what cards they need for sending out for instructions. Now, you might ask, how come the issuers don't know who their shareholders are? Well, that's a feature of the American system. You can, as a shareholder, you can opt between being an oboe or a nobo, an objecting beneficial owner or a non-objecting beneficial owner. And if you're an objecting beneficial owner, then your custodian cannot tell the issuer who you are. and almost all shareholders opt to be objecting beneficial owners, so that the issuers don't know who their shareholders are. They don't have an up-to-date list of who their shareholders are. They have some idea. Investor relations is in charge of figuring it out. The big proxy solicitation firms keep databases to figure out who they are, so that when they have to solicit proxies, they know who to go after. But the books of the corporation don't show who the shareholders are, and there's no way for the issuer to have an up-to-date list of beneficial owners. They have the record owners, but that tells you that, Eynden Company, which is the name by which DTC holds its shares, has 80%. When I was a young lawyer in practice, I was a plaintiff's class action lawyer for 5 years before I went into teaching and did some securities work and some antitrust work. And I had to send out, I think it was in administering a settlement in a securities case we did. And, the shareholder list arrived because we had to send out the amount that we had recovered on behalf of the class. And I went into the partner who was working on the case and said, I had no idea that there was a controlling shareholder in this corporation who owned, 60% of the shares. And he said, what do you mean? I said, look, Eynden Company, they have 60% of the shares, right? Of course they don't. They're just an intermediary. Once you get, so you get the custodians get this request for how many proxy statements, how many annual reports you need. The custodians have an obligation to provide that information. They delegate this job to Broadridge. Okay? Broadridge acts as an agent for the custodians, not for an agent for the issuer. As an agent for the custodians, they're allowed to have access to the customer list, find out who are the various customers. And Broadridge then provides the information to the issuer regarding customer accounts, identifying the number of accounts and shares. At that point, the issuer then sends the materials to Broadridge. Broadridge then sends them out and makes huge profits doing so because they're, as you can see, a monopolist. Their fees are set by the New York Stock Exchange, not by the issuers. The issuers are in no position to go out and seek competing bids. And this is how voting works in the ideal system. So the DTC will send an omnibus proxy off to Broadridge. Broadridge will collect voting instructions. And those of you who got your annual reports recently and went online, I use Vanguard, and I keep thinking of these things as proxy cards, right? They're not proxy cards. They're requests for instructions because I'm not a shareholder. I'm not a beneficial owner. I'm a beneficial owner. I'm not a legal owner. You send in your instructions to Broadridge. They tabulate it and send it on to the tabulator who mixes it along with the record shares and so forth. So what can go wrong? The answer is things go wrong at every step of the way. The issuers don't know who their shareholders are. Sometimes shareholders do not receive materials in time. Now, let me just go back briefly to this slide. This is highly oversimplified because on the bank side, you can have 5 or 6 or 7 levels of piggybacking of custodians, smaller banks who piggyback on larger banks who piggyback on larger banks, so that you can easily have 5 or 6 levels before you get to the ultimate shareholder who's supposed to give the instructions on how to vote the shares. So sometimes the shareholders don't receive the materials in time. Sometimes votes are cast that are not counted. And there's minimal vote verification. You can't tell. You get no, you can't get you can send out your emails and get an acknowledgement of receipt. You get no such acknowledgement of receipt when you send in your instructions for voting your shares. And God forbid you should have to figure out exactly who wins, because coming up with an audit trail is almost impossible. Okay? There are pathologies driven by this ownership, this mismatch between ownership structures. Okay? It's not always clear who owns the shares. So that because of an active market for lending out securities, the securities are often loaned out and the owner may not be aware that that has occurred. The owner may think it owns shares when it doesn't. In the case of, there are cases, this leads to overvoting. So in the case of Taser, which is the company that makes these zapping devices, right? In 2005, 82 million votes were recorded, even though they only had 61 million shares outstanding. Right? Okay? Think about that. So how does this happen? And now I want to go into some of the details of the plumbing, because ultimately this is a story about how your best intentions are limited by the quality of your plumbing. Right? If the technology won't handle it, you can't demand certain things from a system. Okay. So how does overvoting occur? First thing is institutional investors loan out their shares. Why do they loan out their shares? Well, because people want to borrow and are willing to pay for it. CalPERS makes, or has made in recent years, about $130 million a year lending out its shares. Okay? People want to borrow. Why do you want to borrow shares? For all sorts of reasons, one of which is if you have a negative view of what's going to happen to the future of a company, you want to go short. You're not allowed to go short without owning shares. You can't sell shares you don't own. You don't have. That's called naked shorting. That's illegal. So you have to borrow shares in order to sell them short. But a securities loan is not a loan. In legal terms, a securities loan is a transfer. It is a transfer subject to an obligation to restore shares of a like class to at some later date. But you take full legal title to the shares, because otherwise, of course, you can't sell them. So here, the hedge fund borrows shares from Morgan Stanley, okay, and sells them into the market to S5, a customer of Smith Barney. That's how you go short. The hedge fund thinks shares are overpriced and will pay it, will close out the position at a later time and buy back shares at a lower price to restore to Morgan Stanley. But what happens then to the tracing of the shares? At the DTC level, because DTC, at the point that shares are transferred from Morgan Stanley to Smith Barney, at the end of each day, DTC figures out net who has what. So at DTC, there's a debit of the 100,000 shares that have been sold short. But often, at the customer level of the broker-dealer, the securities loan is not assigned to any particular account. There's no obligation to do so. There may be some tax reasons that drive it, but there's no fiduciary obligation to do so. It is not done. So on the books of their customers, their customer books, there's still 1 million shares. So that now when you have voting and Broadridge is asked, how many materials do you need? What kind of voting instructions do we need to collect? It's done based on 1 million shares, not 900,000. Everything then proceeds. And now you have the problem, what if 1 million shares from Morgan Stanley cast votes, even though in their DTC account they only have 900,000 shares? What happens? Sometimes they don't do anything. Deutsche Bank got fined for not reconciling this mismatch. We don't actually know what they do, okay? But keep in mind the problem in some sense, and only some sense, but the problem in some sense occurs even if they only get 800,000 shares. Because what we know is it may well be that somebody is voting who, if they had assigned the securities loan particular account, would not have had any shares in his or her account. Now, the interests, if you're a kind of practical law and economics kind of guy, you don't worry too much because the beneficial owner who does not in fact own any shares still has the interests of a shareholder and will gain the upside or suffer the downside of voting badly. But if you actually worry about who owns the shares, then it turns out you may have a problem. And there are a bunch of other people out there who have economic interests that are the same as a long shareholder who don't get to vote, right? Somebody who has a total return, a cash settled total return swap has exactly the same economic interests of a long-term shareholder, but doesn't get to vote. So there are issues on both sides, and you get, in fact, overvoting. Now, how do you deal with it? Well, you can, if you want to deal with it, you can reconcile the positions. You can either do it pre or post mailing. You can either, before you send out the voting cards, make sure that you've got all your numbers straight. Or you can wait until there's a problem and then try to reconcile it. Generally, the way at least it's said it's done is through some proportional and equitable way, some sort of pro rata, either ex ante or ex post, either a lottery before you send out the cards so that each person has an equal chance to be in the shortfall, or you just scale everybody's votes down, in our example, by 1/10. The problem, of course, again goes back to the practicalities. Okay, there are about 9,000 publicly held companies in the United States, all of whom hold their meetings more or less from March through May. Okay, that's an awful lot of proxy solicitations. That's an awful lot of meetings. It's an awful lot of events. If you do it pre-mailing, you're going to be reconciling in all sorts of situations where there's no overvoting. If you're doing it post-mailing, you're going to be doing it on a post-meeting when there's an overvote, you're going to be doing it on a very tight time frame. Okay. Can you fix the system? Okay. There are a variety of incremental improvements that one might want to use. You can adjust the time between announcing the agenda, the record date, and the meeting date. You can have greater judicial scrutiny. The best proposal that has been made to date is what I would call renovating the structure, which was presented by the Business Roundtable in Georgetown when John was at Georgetown, and it really is John's proposal, which is to essentially push all of everything up as high as you can to a consolidated list in order to minimize the steps. Now, to do this, you'd have to get rid of the NOBO-OBO system and let people who wanted to have confidentiality, to have anonymity, manufacture it themselves. Not a bad idea. The other problem, of course, is that, and this is why the Business Roundtable goes along, if you do this, then once you have a consolidated list, then the issuers can put out the distribution, the processing function out for competitive bid, which of course is why Broadridge was against. But others were against too. The broker-dealers were against because of concern, I think, ultimately that this system, and as we'll see, a more complete change, loosens the links between brokers and their customers. Any sort of genuine consolidated list, as we'll see, loosens the links between brokers and their customers. And I don't know that the institutional investors were in fact much in favor because, of course, anonymity serves the purposes of institutional investors as well. It reduces the amount of scrutiny as to what they're doing. The SEC never acted on this, and it went nowhere when it was proposed. A more fundamental change is to revisit this choice made in the 70s to immobilize share certificates and to do what we probably should have done then. We had the data processing capacity in the 1970s. We certainly have it now, which is to shift from a system of immobilization to a system of dematerialization. What does that mean? Dematerialization means get rid of share certificates. You know, if you call up your broker these days and say, I have a share certificate, I want to sell the stock, most brokers will say, what's a share certificate? I've never seen one of those. Let me find out how to do that, right? Most brokers are too young to have ever had to deal with share certificates. We don't need share certificates. We don't use it for all sorts of bonds and for government securities, right? What we need, and the only way to fundamentally transform the system, is through pure book entry shareholding, uncertificated shares. So, for instance, in Spain, okay, which reformed its system, didn't have a very, post-Franco is when it really started moving into the modern age. It could build a new system from scratch, more or less, and every other country that's building new systems, whether it be China or newly privatized economies in the former Soviet, everybody who's trying to build a system from scratch does it through pure book entry, through a pure book entry system. So in a pure book entry system, you have a central securities depository whose responsibility is to keep the books, okay? Whose responsibility is to make sure that there are no more than 100% of the shares registered, okay? And on each, you can run it in two systems. You could have as a data processing matter, there's no problem with here Iberclear keeping the customer accounts for everybody, for every customer, okay? They don't do it. They do it, each of the participants has a sub-registry. Why? Well, because if Iberclear did it, then you could trade shares by going to an ATM and just selling them, right? You wouldn't need your broker intermediary, or if you wanted to switch from one broker to another, it would be very easy, okay? As a result, in any system, the intermediaries are going to oppose a full centralized registry, but you can get almost everything you need without it. Okay, so in voting in a pure book entry system, you have an up-to-date shareholder list. It's kept on a daily basis by the registry. You can produce a list, send it off to the processor, who now can distribute the materials because it has an up-to-date list, collect the votes. You'll still have problems, but you'll have far fewer, okay? Because you've eliminated many of the steps. It gives you vote confirmation to a much greater degree and a much better audit trail. It eliminates overvoting because here in that system, a securities loan has to be recognized on the books because it's a transfer, and every transfer is recognized on the books, and the Central Security Registry has an obligation that there not be more than 100%. You can shorten the time between the record date and the meeting. You can, for instance, because you have up-to-date daily clearing and settlement, or close to it, you can have a 5-day record date before the annual meeting, which eliminates a substantial amount of the empty voting that goes on. It won't eliminate all of it, but keep in mind that if you have a 60-day record date and an institutional investor sells the shares, because people sell shares all the time, the investor still has the vote because it's the record date shareholder, but no economic interest, okay? A form of empty voting that happens all the time. Here you could in fact, because you can easily update the shareholder list, you can eliminate voting by shareholders who sell post-record date. Okay? Short record date, but you can even make it better. You increase accuracy. No legal impediments to reform. The Article 8 already provides a structure, and Delaware permits uncertificated securities. There's a small transition problem, but it's minimal. There are vested interests, though. They're the Broadridge, obviously, but that's just one firm. Broker-dealers don't want to loosen ties to their customers, as I've said, and institutional investors, on the whole, prefer anonymity in this system by having an up-to-date shareholder list that, in fact, everybody could see if there was demand to see it, exposes institutional investors to all sorts of lobbying by groups, accountability, and so forth, which, as we've seen to date, would just as soon not have. So now let's turn to the other side. If there's problems with the technology of voting that should make us think twice about giving shareholders more stuff to vote on, let's look at the shareholders who are doing the voting, the subject of the earlier panel. The standard account we give our students in the Basic Corporations course is that the reason shareholders and only shareholders vote is because they are the residual beneficiaries of the corporation, and as such, have the best incentives to choose the highest net present value projects. Okay? That's the standard story for it. Of course, saying that shareholders have the best incentives does not mean that they have very good incentives. So should they inspire much confidence? There was a few years ago a tightly fought merger between Compaq and HP. Walter Hewlett, the son of the founder of HP, opposed. He thought the price was too low for HP. And he thought it didn't make business sense. Ultimately, it was approved by a very slim margin. Okay? Who held the shares? Of course, all sorts of people, including a bunch of institutions. There were institutional conflicts of interest. The most egregious or most sharpest one involved Deutsche Bank, which had business relationships with HP and was trying to expand it and so forth. They held a decisive block. But Deutsche Bank, that was discussed very much in the literature, in the paper. There was a lot of attention to that. I'm much more interested in what happened to other institutional investors. Because a lot of the institutional investors who held shares in both Hewlett-Packard and Compaq. Every index fund had an equally weighted position, right? So how did they vote? Suppose suppose you have an institutional investor, an index fund, okay, who holds both Hewlett-Packard and Compaq and believes, with Walter, that on the one hand, or well, he had a different view, believes that the company is worth more together than apart, but the price is too low. Okay, the price for Hewlett-Packard is too low. How do you vote? Now, Easterberg and Fischel would tell you that they would expect an index fund to vote all shares in favor of the transaction, all shares on Hewlett-Packard side and on the Compaq side, because if the companies are worth more together than apart, then it's a value-enhancing transaction, and any problem with the price is a pure transfer payment. It's money from one pocket into another. If you're indexed or close to index, it makes no difference. You couldn't care less. Okay? If you think the companies are worth more together, you should approve the merger. I've talked to a variety of large institutional investors about how they voted. And I'd say around 3/4 of them said, we voted our Hewlett-Packard shares against and our Compaq shares in favor. Okay? We voted the Hewlett-Packard shares against because we voted as a Hewlett-Packard shareholder. We thought we were indeed obligated to vote as a Hewlett-Packard shareholder, and we thought the price was too low for Hewlett-Packard. So we felt obligated to vote against. On the other hand, we thought it was a great deal for Compaq. And so we voted in favor. Okay? Now, how does something like this happen? Right? I was at a conference where there were some finance guys who heard this discussion, and they nearly fell off their chairs, right? They couldn't imagine that the world, finance guys have this kind of naive belief in the world being rational and efficient, right? They couldn't believe that this was how things actually happened. Well, think about how voting happens at institutional investors, okay? Typically, it's a specialized task. In most large institutional investors, it's not done by the portfolio manager. There's a group. At PIA-CREF, it was run by John. There's a group with the responsibility to vote the shares. It's separate from the investment decision. As I understand it, and I could be, and here I know very little, I've just talked to a few people, it's understood to be largely a compliance function and compensated as such, not an investment function, okay? So typically, as I understand it, the people in the institutional investors who vote the shares are not being compensated based on whether the votes they cast increase stock value or not, okay? Now, they do their best, right? But they have, if there are 9,000, right, 9,000 annual meetings a year, and that number's probably wrong, but I don't know if it's more or less, right? If there are thousands of annual meetings a year, there are too many votes for any group to actually look at on a case-by-case basis, so you adopt policies, okay? Now, where do these policies come from? Some of them come from the proxy advisory firms. The proxy advisory firms become much more important, right? The more work you have to do, the more it's a compliance function. The idea is now with mutual fund voting being revealed, it's critical that you get the votes out because otherwise you're criticized, okay? Whether you voted in a way that increases portfolio value or not matters much less than making sure you voted. Now, you can vote in a defensible way if you have ISS saying vote this way. So, who can second guess you if the leading proxy advisory firm says vote this way? How does ISS conclude? Again, here we get to what I would call the question not of evidence-based medicine, but evidence-based voting. What basis do we have for believing that ISS's votes improve shareholder value, that institutional investor votes improve shareholder value? There's now a fair bit of research coming out. Rob Daines and David Larker have a wonderful paper that looks at ISS corporate governance ratings and other corporate governance ratings and finds that they have absolutely no correlation going forward with firm value, okay? None whatsoever, okay? And yet, ISS, Glass Lewis, and the others have become critically important factors in determining who votes. Moreover, if you talk to people, they'll often say this evidence-based voting question is that many of their votes are based on a matter of principle, not based on evidence. Now, principle is a fine thing, but if you're talking about shareholder voting as being likely, or the measure of the value of shareholder voting being increasing firm value, principle as opposed to evidence-based voting doesn't fill me at least with a great deal of confidence. So we have an inadequate voting system. We have shareholders who are not really shareholders in the sense of owning the stock. They're agents too. They're intermediate. They're agents with imperfect incentives just like every other agent. So what should be done? One thing is fix the system. I think it would be a great idea to change from a system of immobilization to dematerialization. I think it has all sorts of benefits, but it's not going to happen. I don't see any indication. There's cost to it. There are entrenched interests who are opposed to it. There are people who don't want the increased transparency, and there aren't, to date, enough really big problems caused by it to galvanize any sort of strong political constituency to change. We could fix the shareholders, right? We've tried. We could impose additional duties and liabilities and disclosure. The problem, of course, goes back to the core problem that bedevils this whole area, which is it's really hard to make any money voting the shares in your portfolio. Some can. Hedge funds who take concentrated positions, they vote like real owners, right? They vote in a way to maximize their portfolio value. Sometimes that redounds to the benefit of all the shareholders, and sometimes it doesn't. It all depends on what the strategy is they're pursuing. But they vote like real shareholders. And the guys making the investment decisions are making the voting decisions. But in a large fund that is indexed or close to indexed, you can't make any money. It's just too small. The reason you centralize this is none of the individual money managers want to be bothered with having to vote the 150 proxies in their portfolio. It's just, they want to be picking stocks. Or we could lower our expectations. Okay, we could say, look, shareholder voting has a place. Nobody else can elect the directors other than the shareholder. We got to do that. That's the minimum. But it's expensive, it's of uncertain value, and that as long as we don't expect it to do more than it can do, we won't be seriously led astray. Delaware traditionally has adopted very much this minimalist view of corporate voting. Right? So you vote for directors in Delaware, you get to veto mergers and sales of all the assets and charter amendments. A veto, if it's plus or minus, if your accuracy is plus or minus 5% on a merger, it doesn't really matter. I mean, yeah, maybe you'll approve a merger that shouldn't be approved. But remember, you have the screen of the board of directors. The board of directors has to recommend a merger before it goes to the shareholders. It seems to me a system where you have no better than plus or minus 5% accuracy. You might get outraged in particular deals like Hewlett-Packard Compact, but as a systemic matter, you don't worry too much. Now we have all these other things. Maybe they're a good thing. I'm still fairly agnostic on it. But in reading the results, if we are going to give shareholders all these other things, we should be very conscious of the fact that the results we're getting may not be accurate to the level we think they're accurate. They'll give you some rough sense if the shareholders, are 55 to 45 in favor or against. They're basically evenly split. If it's 75-25, one way or the other, you know that there's a general view. In Delaware, even when there's a shareholder vote, as we saw in the Bear Stearns, we thought there was a right to a shareholder vote in mergers, and in Bear Stearns, J.P. Morgan Chase, it turned out that in certain circumstances, the management, if they're good enough reasons, can get around a shareholder vote by simply issuing 40% of the shares to the merger counterparty and then letting them go out and buy another 10% in the market so that when you have your shareholder vote, J.P. Morgan Chase already has 50% of the votes. So guess what? It goes through without any sort of problem. That's a shareholder vote, but not one that's taken too seriously. And that, it seems to me, is ultimately the right place to be. Shareholder voting plays a role. It's an imperfect role. We have it. We use it for some things. We've got a bunch of people out there. There's no silver bullet. The reluctant heroes are not going to ride in to save the day, but they have a role to play. But that we just shouldn't expect more than the system can deliver. And let me stop there.
Well, thanks to Ed. That was a very interesting and talk about some interesting issues. Most of what I have to say is not directly responsive, but toward the end of my comments I will come back and I don't exactly, I don't really disagree with anything Ed said, but I do have quite a different perspective on some of the things he was discussing. I want to talk just a bit more about a couple of things that came up in Q&A early this morning regarding institutional investors, and the first is the issue of short-termism. And here again, I've wondered about this for a long time, looking for the evidence of this presumed phenomenon of short-termism, and having a hard time finding any evidence for it. I'm wondering, well, what would a short-termist do? Well, let's see, one thing a short-termist would be opposed to would be research and development, because that's spending money now for profits down the road, and that's not what a short-termist wants. Well, in fact, institutional investors and the market generally tend to react positively to increases in research and development. So where's the short-termism? What about frequent battles over takeover bids, poison pills, and things of that kind? Efforts by investors, especially hedge funds, to get companies to sell off major assets, borrow a lot of money, and then distribute the cash either through dividends or repurchases of stock. Well, first of all, in general, stock prices react positively to shareholder initiatives and shareholder victories, and negatively to defeats of activist investors. Again, Marty Lipton would say, oh, it's just the stock market, that's meaningless. But if you don't think the market is meaningless, then you might think that this is not evidence of short-termism, but something that the shareholders are onto something. Which is not to say that people don't honestly disagree. And, you know, if you're at a big football game and the receiver catches a ball near the sideline, and the referee rules that his foot came down out of bounds, one side of the stadium is outraged, and the other side of the stadium thinks that that was the best call in history. Well, what's going on here? It's half the stadium comprised completely of liars? No, you know, you tend to see things in the way that is favorable to you. And so it's not too surprising that when a CEO or a lawyer who represents the corporation and therefore more or less working for the CEO is going to see that is going to view a proposal from investors to sell off assets, downsize the corporation. Obviously, CEO is not too happy about that and says why. And so the lawyer is going to incline to agree with that and says, short-termism, short-termism. But I'm not inclined to place too much credence in that kind of thing. Again, in fact, to the extent that short-termism is a problem, I think it stems more from managers than from shareholders. Markets can sometimes be fooled. Now, again, the efficient market hypothesis says that the market reacts to all available information. But what if false information is thrown out into the market? Then the market could be fooled, and market prices could be skewed. But institutional investors aren't in a position to manipulate the information that comes from the corporation. Who is? Well, ever heard of pump and dump? CEOs will sometimes cause misleading information to be put out into the market, causing the market price to rise. They then dump their stock, and then the truth comes out. Of course, the CEO's already cashed in. So, yeah, this is an example of short-termism of a kind. But the solution to it is not the Marty Lipton solution, which is to enchain the institutional investors and put them in the deepest dungeon you can find, but quite the opposite, really, to empower shareholders would be the solution. And in fact, more generally, what are the effects of strong shareholder rights? A thing that is admittedly rather difficult to measure, but there have been a number of studies, and they consistently tend to find that strong shareholder rights are associated with a higher stock price and better corporate performance, not the opposite. Another claim we've heard lately concerns going private. Why are public firms going private? Well, again, if you listen to Marty Lipton, what's happening here is they're fleeing the pestilential institutional investors who are trying to force managers to do all these terrible things, and to escape that baleful influence, the company goes private. Well, here again, I have to be skeptical. But then, what does feed the movement to go private? Well, there are a few factors involved here. One being regulatory costs. Obviously, a company that goes private avoids both the out-of-pocket costs of compliance with the SEC proxy and reporting rules, also avoids the intangible costs of having to do life in a fishbowl, having to disclose a lot of things that private companies don't. On top of that, there's now Sarbanes-Oxley, which is particularly onerous and so far as I can see, costly without much corresponding benefit, especially for smaller public companies. But in addition to that, there is the old Burley Means issue, separation of ownership and control, which is what you have in the public company. The people who are running the company are not the people who own it. And when that happens, the people who are running the company are going to have some inclination, to the extent that they can, to run the company to their benefit, not to the benefit of the shareholders, leading to what economists call agency costs. Well, what happens when a company goes private? Typically, two things happen. First, the managers now own a much greater fraction of the stock, so their interests are more closely aligned with those of the other shareholders. Second, a buyout or private equity firm takes a significant position in the company, and that firm has a strong interest in maximizing the value of the equity and doesn't face the collective action problem that institutional investors and all investors face in the case of a public company. As Ed said, it's nice to say that investors should be activists, but if you own 0.1% of the stock, and you spend $1, you make $1 of profit, additional profit for the company, 0.1% of that is yours. How much are you going to spend to get 0.1% of the benefit? Another thing we talked about a bit this morning is the issue of investors having conflicting interests. And in a way, this comes a little bit closer to some of the things Ed was talking about. And indeed, Steve Bainbridge is famous for, at UCLA, is famous for arguing that investors deliberately tie their hands, that investors beg to be powerless because they know that there are fundamental differences among them, and if we had the power, we shareholders had the power, we'd kill each other fighting over the goals of the company. So it's better that we just don't even, just take the power away from us so we won't kill each other. Here, too, it seems to be very little evidence to support that claim. Now, of course, there are a couple of types of investors, shareholders that have special interests, a labor union or a social activist group. But for the most part, shareholders have the same goal, and that is to maximize the value of the equity. What about supposed bad boys of investors like hedge funds and public pension funds like CalPERS? Are their interests fundamentally opposed to those of other investors? Well, again, look at what happens. What happens when the word goes out that some hedge fund is buying heavily into the stock of a company? Do other investors flee and say, they're going to try to do something for their benefit that's going to be really destructive to us. Quick, sell the stock. No. The market tends to react positively. Other investors tend to say, whatever the hedge funds are trying to do to that company is probably going to be beneficial for us as well. So where is the disunity? And if the interests of various investors diverge radically, where are the battles among them? In proxy fights between managers and activist investors, of course, sometimes some shareholders side with managers, but when does one ever see two or more opposing shareholder groups operating independently? When do you ever see, three sides of some fight with separate shareholder groups arguing for different positions? Offhand, I don't know of any such case. Maybe somebody knows of an isolated one. Now, my students know that one of my favorite allusions in class is to Conan Doyle's story of Silver Blaze, in which Sherlock Holmes solves the mystery in part by noticing the dog that did not bark. And if there were major differences among investors, as Bainbridge et al. Allege, then we should see certain dogs barking. We should see certain things happening, and we just don't see them. That dog is not barking. I think actually this in a way could come last, except I want to save my last comments for something that responds more directly to Ed. In the conflict between managers and investors, is this just a battle between two selfish groups? Is it like a battle between two titans, and why would ordinary people care? Is there any reason to prefer one over the other? Well, first of all, as John Wilcox pointed out this morning, these big investors, these big institutions represent a lot of common people, which to my mind is enough reason in itself to favor one side. But there is another issue here that I think needs to be recognized. For decades after World War II, the U.S. enjoyed a privileged status as a locus for investment. Investors unhappy with corporate governance here really didn't have much of an alternative. That is no longer true. Not only have European countries improved their investment climate, but you now have India, China, and many other third world countries now becoming attractive to investors. 2 years ago, the Committee on Capital Markets Regulation, the Paulson Committee, it's not some pointy-headed ivory tower intellectual now, the Paulson Committee said, overall, shareholders of U.S. companies have fewer rights than do their foreign competitors, and that this situation, they said, was impairing investment in America. Ironically, the current economic downturn may be giving us a second chance. Although American markets are way down and plagued by uncertainty, foreign markets seem to have fared even worse. So the capital is to some extent coming back here. But if we don't take some steps to protect shareholders, if instead we continue with what is relative to other countries shareholder abuse, eventually that capital is going to start going abroad again. And bringing out a bit of a comment, again, I don't really disagree with anything Ed said, but I have a different perspective on it. He talked about shareholder voting, and under the current circumstances, everything he said about voting I think is right. But I think the problem is more that management gets to set the agenda and get to decide what you get to vote on. And I think that's where the real problem is. First of all, is with respect to election of directors, it's like a Soviet election. You get to elect. Yeah, there you go in. There's one slate there. You like it or you don't. What are you going to do? There's not a whole lot you can do about it. And then you get some other issues that are more like the Wheel of Fortune kind of situations where you have to vote without knowing what the alternative is. And I appreciated the comment that Catherine Combs made this morning about what if the shareholders vote no on pay? What does that mean? The CEO has to work without pay? Work for nothing? What do you do then? So as a shareholder, you have to say, if I vote no on this, what happens? I have no idea. And so it's not surprising that in those circumstances, shareholder voting wouldn't be terribly effective. Just to toss out as a thought experiment, 2 or 2.5 possibilities I've suggested before, that the official slate of nominees for the board should be chosen not by the incumbent board, but by a committee comprising the 10 to 20 largest shareholders of the corporation. I think then you would get directors who are responsive to shareholders, and then you'd have a very different picture. If that's too much for you, I'll give you 1.5 alternatives. Mark Rowe has suggested a federal rule for public companies that the shareholders should, on their own, be able to choose the state of incorporation. If that were to happen, then we really might have a race to the top among the states, because then North Dakota would have an incentive to adopt a corporate law that would be attractive to investors. As it is now, nobody could opt into it because you have to have the board approval, and boards would never approve that, so shareholders never get to vote on it. And the half alternative is one I'm thinking about myself, which would be optional federal incorporation. That is, that there would be a federal code, and if shareholders of a public company voted for it, then the company would become subject to that federal incorporation. So those are my ideas. And now, Onnig Dombalagian.
Good morning. Let me see if I can set up the PowerPoint here. While we're waiting for this to happen, let me just start off by thanking Case Western Reserve University for having me at the symposium, and again to Professor Dent for asking me to speak on this panel. My topic, which will hopefully pop up in a second here, if I can get the view show. A virtuous cycle, for lack of a better title, legal and regulatory responses to the rise in shareholder activism. This is in some way responsive to both what Professor Rock and Professor Dent addressed, as well as some of the topics that came out on the first panel. Let me first explain where I'm coming from so some of this makes a bit more sense. First of all, I'm not really a corporate lawyer. I practiced in the area of broker-dealer regulation. One of the first assignments I got was to have a pile of securities lending documents thrown on my desk and told, here, comment on these. So I sort of figured out what securities lending was all about, and over the 5 years I spent at my firm, I worked on various projects relating to those kinds of plumbing issues, the infrastructure of securities markets that nobody ever sees. So that's my background. Then again, I do teach these corporate law classes, and the students think I know something about Delaware law, so I have to occasionally write in that area. So I wrote this paper, which I called Can Borrowing Shares Vindicate Shareholder Primacy? Which brings me to the third thing. I am this year applying for tenure, so of course I have to say something unique and provocative. So if what I say seems outlandish to you, keep in mind that it's all in the spirit of trying to get past the university provost. So that being said, what's the basic outline of the talk? We've heard in the various presentations so far that there are these efforts afoot to increase the role of shareholders in corporate governance, and in particular, legislatures and regulators have increasingly looked to shareholder voting, perhaps, as a tool of corporate governance. Why? Well, there are a variety of theories that are typically thrown out. Shareholders own the corporation, and so as owners, they should have the right to make fundamental decisions. They are the best check on management. Somebody has to stand up for the interests of the corporation if the directors if the directors are subservient and management is out to advance its own interests. There's the theory that shareholders' interests are best aligned with those of the corporation, and therefore they should be the ones who have the final say on governance and perhaps in some cases substantive issues. My sense is that legislatures and regulators look to shareholder voting for lack of a better alternative. We've tried everything else. Those of you who remember Sarbanes-Oxley, that seems to be the high water mark of federal interference, or hopefully the high water mark of federal interference in corporate governance. But we need something, right? There is a problem, and legislatures and regulators have to respond to the problem. So the alternative in vogue is shareholder voting, which brings me to the question, well, are there ways for law and regulation to channel shareholder voting so as to improve corporate governance? So assume there is a problem we need to address as legislators and regulators. How do we create a system of rules or a system of laws that channels that shareholder voting power in a productive manner? And to do this, we have to look, well, at least I'll identify three things you might want to look at. First, can you identify shareholders with properly aligned interests? Some might say all shareholders have properly aligned interests. Others might say that there are a variety of competing, constituencies even among the shareholders with different agendas. But assume that you can identify shareholders with properly aligned interests, find some proper subjects for shareholder action, and then create the incentives for active participation. So I think if you could accomplish these three things, then you might have a case for some sort of legal or regulatory effort to improve shareholder voting, or to channel shareholder voting to improve corporate governance. And the test I'll suggest is a variant on the empty voting problem. To the extent that empty voting is an issue that has vexed many commentators, I turn it around and say, is this perhaps a solution? Now, I say this in a hypothetical way because I don't really think it is a solution, but I think thinking about the process of generalizing empty voting, think about shareholders voting other people's shares when it's in their incentive to do so. Can that, to a degree, address some of the problems that we've identified with the shareholder voting process? And if not, what does that say about the shareholder primacy movement and the role of shareholder voting in corporate governance? So let's just start off with a basic checklist. We know that law and regulation today limit the scope and exercise of the shareholder franchise in various ways. This is the traditional position. Directors manage the affairs of the corporation. We have listing standards that today dictate the composition of the board, so it's very difficult to figure out how shareholder, or at least some would argue that it's difficult to figure out how shareholder nominees should fit into the different board committees that are mandated by stock exchange rules or SEC rules. We have beneficial ownership disclosure rules that discourage individuals from taking large stakes, that discourage perhaps shareholders from acting in concert for fear that they might trigger the requirement to file a Schedule 13D, and also deters them from actively influencing management if they want to take advantage of the lesser disclosure regime under Schedule 13G. We have rules that govern proxy solicitations and other shareholder communications. These, to a degree, have been liberalized, but a lot of these rules remain in place. There are also rules, as were mentioned on the first panel, governing communications between management and shareholders, such as Regulation FD. All of these, to a degree, have a deterrent effect on the process of communication that's necessary, perhaps, to mobilize a shareholder voting base. We know that there's limited access to the company ballot for shareholder initiatives. If you want to mount some sort of proxy contest or push for a vote on a matter, you have two choices. One, you can try to get it included on management's ballot, or two, you can try to solicit proxies directly. The latter being prohibitively expensive for people who are interested in issue voting. Your best bet is the 14A8 process, and the SEC has traditionally limited what goes on management's ballot under 14A8. And then finally, fiduciaries to a degree are subject to a cost-benefit analysis when they contemplate expenditures on corporate governance. Now, is this an excuse? Is this a justification? I don't know. I'd be curious what others think. But to the extent that the task of soliciting proxies, mobilizing shareholder interest, and so forth costs money, how do you assure that there's a reasonable relationship between the costs you expend ex ante and the results you get in the way of improved shareholder performance, corporate performance ex post? So these are some of the things that law and regulation currently do to limit the scope and exercise of the shareholder franchise. So what's being done to facilitate the exercise of the franchise? To the extent there's a movement in favor of shareholder voting, there are tasks that one could do to improve the voting infrastructure. There's a proposal in the Delaware legislature to permit multiple record dates for shareholder meetings. So one record date perhaps for notice, one record date for determining who gets to vote. This might allow greater negotiation among shareholders. It might give shareholders notice that a meeting is occurring so they can get back shares that they've loaned, or they can increase their ownership interest. This is one way, perhaps, that you can improve the voting infrastructure. As Professor Rock mentioned, there are efforts to police naked short selling. This is maybe perhaps a way to make sure that the votes actually represent the interests of the people who own those shares, as opposed to the kind of overvoting he discussed. Facilitating communication among shareholders. Again, the SEC has taken certain steps to allow shareholders to more freely discuss their voting intentions with respect to particular elections, with respect to particular matters, without being required to comply with the proxy rules. There has been a suggestion, or at least the rule has been adopted, that electronic shareholder forums might be a way for shareholders to exchange ideas. So we have new SEC rules that encourage the use of electronic forums for shareholders with a safe harbor prior to the actual shareholder meeting. And then, of course, there's efforts to reduce the cost of mounting a proxy contest. So promote the availability of proxy materials by internet. Think about rules that broaden access to the management ballot. And think about rules that reimburse shareholders who undertake the expenses of mounting some sort of proxy contest. So, again, there are certain obstacles to mobilizing the shareholder vote. There are legislative efforts afoot or regulatory efforts afoot to try to facilitate the exercise of the franchise. So we come back to the original question, what are the conditions on which law and regulation could channel shareholder voting in order to improve corporate governance? So we said identify shareholders with properly aligned interests, identify proper subjects for shareholder action, and then create incentives to exercise the franchise. Let's look at each of these. Which shareholders' interests align with the objectives of corporation law? This has been discussed in both the first panel and by the prior speakers on this panel, so I'll just put up the list for your review. Some people think of institutions as a monolith. We all have the same goal. It's maximize share price. There's really no need to look any further. Others will say that certain constituencies have interests that diverge. Mutual funds may have a desire to curry favor with management if they manage, 401k plans or pension funds. Some disagree, like Professor Rowe. Others advance this as a possible conflict of interest. You have private pension funds, passively managed funds. Passively managed funds don't necessarily want to use their management funds to engage in proxy contests, because half the allure of these funds is the low fees they charge. Insurance companies, possible long-term investors there. Public pension plans, to what extent are their agendas driven by politics as opposed to wealth maximization? Union pension plans, again, to what extent are their interests driven by negotiating labor agreements as opposed to maximizing investment returns? Hedge funds and private equity, no need to go further there, and broker-dealers casting discretionary votes. Professor Rock talked about some of the implications there. But, again, let's assume that we can find shareholders whose interests align with the objectives of corporation law. Some of the criteria that have been used, for example, in law and regulation are to look at economic interest. What percentage of the shares does a particular institution own? That might be a sign of their bona fides. How long have they held those shares? So some rules will look to see whether or not you've held shares for a significant period of time as evidence that you have an intention to hold those shares going forward. To what extent have you been successful in getting shareholders to rally around your cause? If you've been successful, perhaps that militates in favor of giving you greater privileges with respect to shareholder voting. If you have not been successful, maybe that militates in favor of striking your proposals from the management ballot, for example. More recently, some thoughts about, some more recent efforts to hone this further. We had some SEC proposals in 2003 and 2007 regarding shareholder access to the ballot. Some of these were keyed on whether or not you qualified for Schedule 13G. Are you an institution with no intent to influence or control management? Are you a passive investor, again, who has no intent in acquiring a controlling block? Maybe that's a criterion for somebody who's got long-term interests that are not antagonistic to those of management or not antagonistic to those of the corporation. What about a financial commitment, the willingness to post security for costs or security in the event that you say something materially misleading in your solicitation materials? Maybe that will weed out folks who are just there to grind an axe and favor those who have an actual financial interest in advancing a particular proposal. So I mentioned, again, there are various examples of this. The SEC proposed rules regarding nominations by shareholders. Delaware is considering a proposed Section 112 that would permit corporations to adopt bylaws that determine eligibility for nominating candidates for the annual directors election based on their economic interest, duration, and other criteria spelled out in the proposed legislation. And again, there is a Delaware Section 113 that would permit proxy reimbursement for shareholders, again, based on various criteria such as the ones discussed on the prior slide. So, if we can find shareholders whose interests align with those of the corporation or whose interests align with those of shareholders generally, what are the proper subjects for shareholder action? And here we come to some of the particular issues that were discussed in prior panels. I mean, election of directors, that's a given, right? That shareholders are the ones who traditionally elect the directors. The recent efforts have been to consider whether or not, for example, shareholders can participate in the process of deciding what an election should look like. For example, do we vote by plurality? Do we vote by majority? Efforts have been made to allow shareholders to nominate individual directors of a short slate. You know, whether such directors could be effective on a board or whether or not you really want a team of directors who view themselves as not representing different constituencies. That's something that we can consider as a policy matter. But these are some of the suggestions that have been put forward with regard to the nomination and election of directors. Slightly more controversial is allowing shareholders to participate in procedural aspects of corporate governance. So traditionally, we've allowed shareholders to ratify conflicting interest given special deference to ratification of control transactions. But what if we push this further? What if we allow shareholders to authorize proxy expenditures or to adopt bylaws authorizing proxy expenditures under certain conditions? What if we allow shareholders to dismantle defensive measures? Right. Again, one might argue that a lot of these are yes or no, up or down votes that are the kinds of things that are suitable for shareholders to decide on, and to the extent that they increase the value of the company because they permit, greater debate and create more excitement at shareholder meetings, why not? Legislators are considering them. The most controversial is substantive decision making, because here you're not dealing with up or down votes, but a range of possible outcomes. So with mergers, traditionally again, or sales of substantially all assets, or other fundamental transactions, you get an up or down vote on the transaction that the board is proposing. With executive compensation, the point was made, right? What does an up or down vote on executive compensation mean? What you really want is a negotiation process that may ultimately lead to an up or down vote, but even that's going to be difficult to arrange among shareholders. Some have suggested, Professor Bebchuk, I think, has suggested that shareholders should have a role in setting business policy, sale of particular assets, share buybacks, dividends, changes to capital structure, and so forth. Again, the question is, how do we most effectively channel shareholder voice into this process? Is it a pre-vote negotiation? Is there actually a vote on these matters, or is the shareholder role in this process merely advisory? The more the number of alternatives, the broader the range of possible decisions, the less perhaps justifiable is the case for some sort of actual shareholder intervention via a vote, as opposed to informal shareholder consultation. Rather than tick through each of these, I'll just note that this process of deciding what is a proper subject for shareholder action has been the subject of controversy, both in the context of 14A8, deciding what is an appropriate matter for a company ballot, and in the context of Delaware law, deciding what is an appropriate matter for a shareholder bylaw. So a variety of cases in recent years discussing this issue in different contexts. So here's the last of the troika, right? How can law or regulation improve incentives to exercise the franchise? One thing you can do is discourage apathy, right? So make people document their share lending practices. Tell us whether or not you actually recall shares that you've loaned out before the record date. If not, why? What's your policy? To the extent that you can encourage institutions to recall shares before material votes, in some case this is considered part of a manager's fiduciary duty, you can focus their attention on the importance of the voting process. You can require them to document their voting practices and their voting records. Have a policy that specifies how you plan to vote your shares. Keep records of how you voted in individual shareholder matters. And then the question is, well, do you make these available publicly or not? There was obviously an issue a few years ago when the SEC required mutual funds to disclose their voting records. Discouraging apathy is one thing. Encouraging active participation is another. Here we get a little vaguer, right? You could redefine fiduciary duties with respect to investment policies. I have an example of this on the next slide. And then you have things like John Bogle's federal fiduciary duty for institutional money managers, the one that was discussed in the Gretchen Morgensen profile with John Bogle in the New York Times the other day. So it's one thing to say, well, you shouldn't be apathetic. It's another thing to try to mobilize institutions who may not otherwise have an interest in participating in these debates to think of them as part of their fiduciary duties. So we have, for example, a Department of Labor interpretive bulletin for ERISA plan trustees, which endorses this idea of shareholder activism to a limited degree as part of a shareholder's fiduciary duty. Investment policy contemplating activities intended to monitor or influence management is consistent with fiduciary obligations if the fiduciary concludes that there's a reasonable expectation that such activities will enhance the economic value of the investment after taking into account costs. Not a ringing endorsement for shareholder activism, but at least a recognition that in some cases it is a justifiable expenditure. And the Department of Labor goes on to say that some of the issues where active monitoring and communication would be appropriate might include executive compensation, M&A, capital structure, long-term business plans, workplace practices, other financial and non-financial measures of corporate performance. But then they go on to counsel investment fiduciaries against legislative participating in policy issues that deal with legislative, regulatory, or public policy. So your focus is maximizing returns for the plan beneficiaries, not pursuing a broader activist agenda using your management fees. So to kind of wrap all this up in the last two slides, empty voting, this idea that people can vote shares that don't belong to them. In fact, they can vote shares if perhaps they have a negative financial interest in the company, has sparked part of this debate about whether or not shareholder voting is a good thing or a bad thing. To the extent this possibility exists, there is a strong argument that the shareholder voting process should be scaled back. I turn it around and throw out the following sequence, which hopefully will not elicit too many groans, and trust me, I don't believe it any more than you probably do, but I throw it out as a thought experiment, right? So the conceit of the story is, if there exist institutional investors with interest in long-term wealth maximization, and it is efficient for them to incur short-term costs to serve that interest, then they should be willing to participate in a public stock lending market. And this would be a market in which, for example, institutional investors could borrow shares held by people like me who use, proxy cards to, line the cat's litter pan. No offense. I only own 100 shares of each company, so I'm rationally apathetic. So you have a hypothetical market for borrowing public shares. Institutional investors can borrow shares from people like me through an exchange or clearing agency mechanism. We would limit the scope of firms to top-tier firms because, again, it's unreasonable to expect that institutions would be able to actively participate in the corporate governance of every company out there. That's just inconceivable. We would limit it to a class of shareholders that we might think is eligible. For example, Schedule 13G comes to mind. Give those folks a leg up by allowing them exclusively to participate in such a market. We would borrow wholesale the legal structure of securities lending transactions. Again, to the extent this involves a transfer of title as opposed to the assignment of a proxy or the designation of a proxy, you can avoid most of state proxy law and just focus on governing everything federally through the clearance process. Retail shares, people like me, could be loaned on a blanket basis or upon instruction in individual cases, as long as the record date is set at an appropriate interval to permit this kind of transaction to take place. Institutions might borrow shares in anticipation of record dates for shareholder votes or tender offers, etc. You get the picture, right? You don't really need me to spell all of this out. What's the gist of this? Well, again, the argument is if you believe that shareholders can participate meaningfully in corporate governance, this kind of market should make sense. If their interests are aligned, they can rationally figure out what maximizes corporate welfare. We should trust them with the process. And to the extent there are diverging interests between institutional, so your traditional 13G investors and the hedge funds, those will come out in aggressive bidding. To the extent there aren't, which is probably going to be the case most of the time, there won't be a need to invoke this market, right? So the first thing it does is it pressures institutions to think of the voting process as part of the investment, right? Not only do we own the shares and have the right to dispose of them, but our ability to vote the shares is part of our investment monitoring. It allows those shareholders who are, inclined, who look favorably upon management to signal that kind of long-term commitment. There's a lot of literature, the Blair and Stout literature about, trust among constituencies. One way that shareholders and managers, or shareholders and directors and managers can cultivate the requisite trust is through shareholder actions that support management, as opposed to just voting in favor of the management ballot. Oh, I got that one. Focus actions on wealth maximizing proposals. Again, to the extent that what we're concerned about is shareholder voting being used for the purpose of increasing corporate welfare. A market in which votes can be borrowed for money creates a price that determines what the value of the vote is, in theory, again. And the idea is that this would focus activism on the wealth maximizing proposals to the exclusion of the other type, gadfly type issues that might be perceived as a distraction and undermine the shareholder voting process. My bottom line is, if this seems implausible, what conclusions can we draw about the role of shareholder voting, right? If the conditions that we've identified, there are shareholders out there who are capable of voting intelligently, their interests align with those of the corporation, they can vote on proper actions and have the incentive to do so, this kind of market works in theory. But because of the many pathologies we've identified in the voting process, because of the many concerns we have about whether or not the vote will be wielded intelligently, my sense is that most people would react very negatively to this. Better to trust the directors, or better to trust, state or federal fiduciary duties, well, state fiduciary duties for the most part. Better to trust the other mechanisms that we have to police corporate governance than give a lot of power to an untested device that historically has been disfavored. But I throw it out there for your consideration. There's a question mark at the end of it, which means your guess is as good as mine. Thank you.
Yeah.
Oh, you want to take that down?
Ed, you have only about 10 minutes to respond to the commentators.
Well, I thank both of the commentators. I thought the remarks were extremely interesting. I have no idea how I think about Onig's very creative and provocative proposal. I want to just spend a couple of minutes responding to the comments from a slightly different perspective, which is what, if anything, we can learn about the subject of this panel, the subject of this day, from the events of the last year. For me, watching the meltdown has really shaken some of my core assumptions about the way corporate law works. Right? A lot of what we've talked about the last 20 years in terms of reforming corporate law has been a version of incentive management, better alignment between shareholders and managers, changing compensation practices so that managers will think more like shareholders, as well as a system of checks and balances, of giving greater power to shareholders to check managers either directly through the voting process or through a market for corporate control. What's so striking to me about the meltdown is that it seems to call both of those into serious question. I don't know what the solution is, but it seems to call both of those into serious question. So if you look at Bear Stearns and Lehman Brothers, the CEOs of those firms owned $1 billion of stock in their firm. Okay? It wasn't their entire wealth, I'm sure, but it was certainly most of their wealth was tied up in the stock of their companies. They had incentives that were extremely closely aligned with those of shareholders. They had the most dramatic sort of pay-for-performance imaginable. And yet, nonetheless, the firms ended up being levered up 30 times and disappeared in the maelstrom, right? Now, I don't know what happened there. I can't figure it out. I don't think it's a story of boards being asleep at the switch. These were quality boards. AIG had quality board. And these were quality people who were not in the traditional sense in the pocket of management. They often also had substantial stock interest. The boards didn't catch it, not I think because they weren't incentivized to catch it, not because they wouldn't want to catch it. They just didn't, right? Maybe it was something you couldn't catch. Maybe the worst problems are problems that incentives aren't going to solve and that good intentions aren't going to solve. So what I take away from this is a sense of disconnect between the traditional topics of corporate governance, which many of us have spent a long time thinking about and writing about, and the events of the past 2 years. Would giving shareholders more of a say have changed the outcome at Bear Stearns, J.P. Morgan, Bear Stearns, Lehman, or AIG? I can't believe it would. Partly because the shareholders had no more of a clue as to what was going on than the managers did, than the boards did. Which brings me in a roundabout way to George's comment about this skepticism about whether there is a short-termism problem. I take it a plausible example of this short-termism problem is the phenomenon of a shareholder activist, of a hedge fund proposing to a firm that what they really need to do is to borrow a whole lot of money and pay out a large dividend or buy back shares. Because we thought we knew, that debt was a very good disciplining device and that free cash flow led managers to do silly things. And when hedge funds proposed this, often firms caved in because the pressure came from the other shareholders to do so. And of course, when they did that, the stock price went up because that was what the shareholders thought they wanted. But then, and the managers, when they would say things like, well, it's good to keep dry powder because, when things turn, when the credit markets tighten, it's not so easy to refinance. And a lot of people said, oh, that's silly. How could anybody think that? And of course, we now know that a bunch of the people who said that were correct, that it may have been in the short-term interests of the hedge funds who were going to cash out their positions once they induced the payout of a substantial dividend, which resulted in a stock price. It may well have been in their interest. They sold out, and the long-term shareholders like TIAA-CREF stayed in, and we now know, at least in some circumstances, that was probably a bad idea, right? That a bunch of companies suffered by paying out those amounts. So that does seem, to get to George's point, it seems to me that is a plausible situation for us to worry about, that looks like boards, managers giving in to pressures for a short-term stock price in a way that did not, in fact, benefit the long-term shareholders. Let me stop there.
I share Ed's bafflement. I don't know. Maybe this is all know the adage that hard cases make bad law. Maybe extreme economic events make for bad policy. Maybe this is just something that is so unusual that we just have to treat it as unique. I would only say in response to what Ed said, I agree that in many of these cases, it doesn't seem that greater shareholder rights would have helped. On the other hand, it's clear that in some cases, at least, excessive CEO power was part of the problem, where CEOs had compensation packages largely designed to appeal to them. That gave them huge compensation for certain short-term performance. Yeah.
Just in response to to Ed's question, another way of looking at what happened to us is to recognize that the origins of the problem were in Wall Street and in the financial services industry, and that what happened was that the values and the practices of the financial industry, which had been traditionally quite isolated, started to spread into other areas of business. And the classic example of this is Enron. The managers of Enron wanted to be an investment bank. They wanted to be a trading company. They wanted to command the kinds of salaries that were traditionally offered only within the financial services industry. They wanted to have the same kind of incentives. And as a result, they used fraudulent means to do that, and they did things within that company that a company is not entitled to do. And we have seen in our lifetimes two examples of bubble markets. And the second one, particularly the one which we're just struggling out of now, is one in which it seems to me there's a cultural dimension in which the values and the techniques of Wall Street spilled way beyond Wall Street, where they had been contained traditionally, and have in a sense contaminated our way of thinking about doing business and also about our values and what we should look for over the long term. Whether we can go back again is a very difficult question. I'm not so sure. It goes along also with the celebritizing of everything in our culture, and the also 24-hour-a-day communications and exposure that tends to trivialize and make thinking a little bit shallower about issues. So we focus on the more superficial financial gains. I don't have a solution, but I think that the question of whether or not giving more rights to shareholders or having better corporate governance could prevent that kind of phenomenon, I think, is a bit beside the point. I would also just say that one thing I think that you underestimate about voting is its ability to influence the behavior of directors. And this is more a human element than it is a way to get companies run better by the specific action or advice of shareholders. Nell Minow has a great quote. She says, directors are like subatomic particles. They behave differently when they are being observed. Shareholder voting is a form of observation that is highly visible and to which directors are very sensitive. And I think that the value of a referendum is not to make directors do very specific things, but to make them think and behave differently, and to make them think about the consequences of their actions on an audience who will review them through a referendum.
Can I just...
Okay.
I have a brief comment. I would say it will take less than a minute, and I wrote a little bit of outline. From the first panel, the investor-shareholder perspective, I conclude that the pro-vegetarian decisions of the sheep worth nothing as long as the wolf thinks otherwise. From the second panel, this now activism, voting, gambits, and tender offers, I conclude that the governing principle for the directors and managers is the principle of the diffuse responsibility. Nobody that vote, that fly over, you buy some, you transfer some, and they are all completely becoming untraceable and untrackable. So what is the solution for that? I think that the shareholders, not individually, but as a group, as a bulk, they both control the purse strings of the money because they are the investors. And they control with their votes, they can bark as loudly as they want to and state their opinion. And this way, using these two means that they have, they can participate meaningfully in the process and suggest a course of action and rules that are both just and right, and at the same time protect and advance their own interest. You cannot be a victim without your consent. So if the investors decide to be the victim, and it occurred to me that what you are describing now is a Ponzi scheme. Basically, you have managers that part of the compensation is shares in the company, that whatever it is that they manage, and then they trump up the market, have short-term gains.
Okay.
Everybody buys
you don't
them,
have a do you have a question?
No,
Okay.
I said in the beginning
Okay,
that I
think
that will be
okay.
about a minute, and
Okay.
it took me about a minute and a half.
Okay. Ed, did you want to say one more thing?
I wanted to just briefly respond to John. I agree with what he said. I think it's one striking thing we know looking around is how sensitive boards have become to shareholder views. So, for instance, and this is independent of spreading the franchise and increasing the number of proposals, there has been, for instance, an astonishing disappearance of staggered boards among the largest companies. Okay, they're disappearing. It was, various critics viewed staggered boards as the one remaining significant anti-takeover device, and in the last 3 years in the Fortune 500 companies, 2/3 of them have just disappeared by management action. That takes board action to get rid of them. The majority voting rule swept, within 12 months, swept companies. Poison pills, when they expire, now are not being renewed, okay, because of shareholder views against them. So that it seems to me that what is puzzling to me is I think we're living in an era of boards paying particular attention to shareholders, of markets that are more efficient than they've ever been, and that notwithstanding that, we've had in the last 10 years 2 bubbles. And I don't quite know how those pieces fit together.
I think we have lunch, Alice. Okay. And thank you. And the next session will begin at 1:30.